Welcome to the weekly wrap-up where we take a look at what economic events were moving and shaking the markets this week. Today I am joined on the line by Philip Shaw, Chief Economist at Investec. Philip, in your view, what were the most important economic events that impacted the markets this week?
Well, as ever, there's plenty going on in global financial markets, but I think if I was to point to any data points or set of data, I'd be looking at the US surveys which have been released this week. In particular, the Empire State Manufacturing Survey, the National Association of Home Builders Index, and the Philly Fed survey as well. And they have all indicated that there is a slowdown in activity in train. You know, we had some reassurance, for example, from the Fed's Beige Book that growth is continuing moderately in most areas. But it does push into focus that although we're likely to see next week's GDP number strengthening to around 3% from 0.4% on an annualized basis, that's for Q1, but the second quarter is likely to show some sort of a soft patch. So it calls into question really the speed of the global upturn and of course from an investor perspective whether they are in risk-on or risk-off mode.
On Monday, China's GDP quarter-on-quarter fell to 1.6% and year-on-year GDP fell to 7.7%. What do you think this data means for the Chinese economy?
Well, it was a bit of a surprise, given that a number of the other conjunctural indicators were implying that we could get something in year-on-year terms of around 8%. So I think in terms of Chinese activity, we put it on watch at the moment to see whether we are looking at a trend slowdown in growth. On balance, we tend to view that the Chinese economy is not slowing down, that there continues to be positive momentum, particularly with certain elements of domestic demand growth beginning to pick up, and that we're likely to see GDP growth of around 8% this year, and indeed that's exactly what the IMF was forecasting when it released its forecasts earlier this week.
What did you make of the Reserve Bank of Australia meeting minutes for April released on Tuesday?
Well, I think overall what they were suggesting is that the RBA is in no rush to ease again. It did point to some strengthening in the housing market, pick up in retail sales, for example. But overall, the bank is has got an easing bias, so that if it needs to cut rates again, then it will do. And the minutes did point out that the inflation outlook was benign, and it meant that there is room to cut interest rates again if necessary.
And UK unemployment figures were released on Wednesday, rising at the fastest pace in more than a year to 7.9%. Do you think this is further evidence of a weakening UK labour market?
Well, I think if you'd asked me the question a month ago, the puzzle would have been why the UK labour market has been so strong over the past year, and it's very difficult to quantify why we've had employment growth of 2% over the year when the economy's been more or less stagnant. So we're not totally surprised that we're beginning to see some signs of unemployment rising, and indeed employment levelling out and showing a small fall in the past 3 months. You know, the figures can be a little bit volatile on a 3-month basis, but we suspect that yes, the very good stellar performance from the labour market is probably something that we can consign to history, and we're now looking at a flatter period.
Thanks for joining me, Philip. I am now going to leave you with some expert quotes from our interviews throughout this week. Have a great weekend and goodbye for now.